Welcome back to the deep dive. Our mission, as always, is to just ignore the executive summary and really drill down into the fine print.
Because that's where the real story is.
Exactly. That's where it lives.
Yeah.
We're trying to give you a shortcut to understanding these really complex documents, and today we are tackling a beast.
It is a big one.
A massive, real-world regulatory filing, the 2017 10K of HCA Healthcare, Inc.
Right.
Now, a 10K, for anyone who doesn't live and breathe this stuff, is a mandatory filing with the SEC. It is the authoritative annual report. And we are treating the single document, the audit report, the main financial statements, and especially those critical footnotes as our one and only source.
The whole roadmap is right there in the filing.
That's the idea. Our goal for you is to walk away knowing not just what the numbers are, but maybe more importantly, why HCA chose to present them the way they did.
And HCA is, it's an excellent choice for this deep dive. HCA Healthcare is a titan in its field. They're one of the leading healthcare services companies in the entire United States. When you look at their size, just back in 2017, it's kind of staggering.
Okay, so give us the scope. Just how big of an organization are we talking about here?
So as of the end of 2017, HCA was operating 179 hospitals.
Wow.
But it doesn't stop there. They also had 120 freestanding surgery centers and another 195 access centers.
And what does that include?
That's all those neighborhood freestanding ERs and urgent care centers that you see, popping up everywhere.
So we're definitely not talking about a small regional operation. This is a massive national enterprise.
Oh, absolutely.
Yeah.
Their facilities were spread across 20 states, and they also had operations in the United Kingdom.
Okay.
So that sheer scale, it basically guarantees their financial documents are going to be inherently complex. It makes it the perfect roadmap for us to see how these huge service organizations report their health.
Okay, so let's unpack this, and let's start at the absolute beginning, which I think is the most overlooked part of the entire document.
The auditor's report.
The auditor's report. Everyone just flips right past this page to get to the income statement, but that first paragraph is everything. That's where the actual opinion is.
That opinion is the foundation, is what everything else rests on. But strategically, what really matters is the rest of that report.
What do you mean?
It clarifies that the auditors are not guaranteeing perfection. They're only providing, and this is the key phrase, reasonable assurance for the opinion they're giving.
So they're verifying the integrity of the process, not every single number.
Exactly. Not every single transaction.
That distinction, reasonable assurance versus an absolute guarantee, that feels crucial. Doesn't that lack of certainty sort of weaken the whole document for an investor, knowing it's just a process check?
Well, it raises a valid point about risk. What it really means is that you, the reader, need to understand that management made choices within GAAP that the auditors just verified were consistent and reasonable.
So the document itself is not infallible.
Not at all. And that's why that report is the required starting point. It sets the parameters of what you can actually trust.
Okay, so once we understand that framework, we move into the actual statements. And the SEC dictates a very specific rhythm for these filings, which is vital for comparison.
It is. That consistency is mandatory, especially if you're trying to track a company's health over time or, compare it to a competitor.
So what are the rules?
The 10K filing must have 3 years of income statements and 3 years of statements of cash flows, but, and this is interesting, only 2 years of balance sheets. This regulated presentation ensures that analysts can consistently compare that year-over-year performance.
Fantastic. So let's jump right into the financial meat, starting with the income statements. When we look at HCA's structure, we immediately hit a couple of surprising things.
Yeah, things that show why a massive healthcare provider is just structurally different from, say, a car manufacturer.
Right.
This is really where being a pure service organization just changes the rules of the game for analyzing profitability.
Exactly. So the first big difference, HCA has no section for cost of goods sold.
Because they're providing a medical service, not selling a widget.
Yeah.
They don't have product costs in that traditional sense.
And the strategic implication of that is huge, right?
It's massive.
Yeah.
Since that traditional metric of gross margin, revenue minus cost of goods sold, it just doesn't apply.
Yeah.
So the core measure of profitability shifts entirely.
What?
For HCA, the focus immediately goes to efficient service delivery and labor control. Because labor and admin costs, they replace material costs as the big expense you have to scrutinize.
And the second structural choice HCA made is how they define their core profitability. Instead of recording operating income, which is Pretty standard.
They've chosen to lump everything together.
They do. They combine all their core operating expenses, other expenses, revenues, and the first major subtotal they give you is income before income taxes. So what's the analytical implication of that choice? By skipping a clear line for operating income or EBIT, are they maybe obscuring the true core profitability of their healthcare operations, at least from the casual reader?
I think strategically it means you have to dig a little deeper to isolate their true operational efficiency. Operating income is generally seen as the purest measure of how well the core business is running, separate from, say, financing decisions or tax rates.
So by not breaking it out?
By not providing it as a subtotal, they force you to do the math yourself, which can sometimes mute the visibility of, say, operational fluctuations.
Interesting. Okay. Now, even within that income statement, they have to account for passive ownership.
That's right. The statement reports HCA's share of the earnings from subsidiary firms.
And those are?
Those are the firms where they own between 20 and 50% of the stock. So they aren't fully controlled, but the relationship is significant enough that they have to report that proportional share of earnings.
Got it. And then, following the income statement, we usually get the comprehensive income statement. HCA made another choice here to separate how those earnings are calculated.
Yeah, they chose to show their comprehensive earnings calculation in its own distinct statement. They take the net income we just talked about and combine it with something called other comprehensive earnings.
Which could be what?
Things like unrealized gains or losses on certain investments, or maybe foreign currency translation adjustments. By separating it out, they make sure the volatility of those non-core items doesn't cloud the main net income figure.
Okay, let's move to the balance sheet. Our sources say the balance sheet itself is fairly standard. Assets, liabilities, equity, all at a specific moment in time.
Correct. But closely linked to that is the statement of stockholders' equity, which HCA actually calls a deficit.
Right.
And for a lot of listeners, seeing the word deficit linked to a massive successful company might be, a bit confusing.
So why would a multi-billion-dollar corporation like HCA show an equity deficit? I mean, equity is just assets minus liabilities.
This gives you a really powerful insight into HCA's financial strategy. An equity deficit doesn't usually mean the company is losing money year after year.
So what does it mean?
It often means they have been aggressively buying back their own stock. Stock buybacks reduce the amount of equity on the balance sheet. So in HCA's case, it shows a very conscious, strategic choice to return capital to shareholders rather than retaining it as equity. It actually pushes that number into the negative and reveals a really aggressive financial posture.
That context changes the entire perception of that statement. Okay, let's transition now to the third main statement, the statement of cash flows. This is where we reverse all the accounting magic and see the actual cash.
If you connect this to the bigger picture, the cash flow statement is often seen as the best indicator of true operational health.
Because it's just cash in, cash out.
Exactly, because it reverses all that subjective judgment that's inherent in accrual accounting. And what's fascinating here is that HCA uses the indirect method.
Okay, for those of us who haven't looked at a 10K in a while, what does that choice, the indirect method, actually mean, and why do they use it?
So the indirect method is usually easier for companies to prepare. They start directly with that net income figure we talked about, and then they just list all the adjustments needed to back out the non-cash activity to get to the true cash flow.
Easy for them, but what about for us?
Well, while it's easier for HCA, a lot of analysts actually prefer the direct method, which shows the raw, real cash receipts and payments. The indirect method kind of masks those exact raw movements inside the adjustment process.
So tell us about those adjustments. They happen in two blocks, right?
They do. The first major block reverses accruals that are associated with changes in current assets and liabilities. So think changes in accounts receivable or accounts payable.
So if receivables went up, cash went down.
Exactly. So that's a negative adjustment to net income. Then the second block is for adjustments that review non-cash activities that impacted net income. The most common one is depreciation and amortization. Since depreciation is an expense that lowers net income but doesn't actually involve a cash outflow right now, you have to add it back.
And there's a simple directional rule for anyone reading this, right? Inflows are positive, outflows are negative. A key detail.
Absolutely. Cash inflows are always presented as positive numbers. Outflows are always presented as negative. It's structural. It's non-negotiable.
Okay. Here is where it gets really interesting, and this is where the most crucial analysis begins. The footnotes. We've covered the three main financial statements, but if you stop there, you've completely missed the context, the rules, and the risk management of the company. The footnotes are not optional reading.
They're essential. They're the required context, the fine print that tells the story behind all those summary numbers. Our sources highlight 4 crucial categories, starting with the one that is always, always first: accounting policies.
And why is that footnote always positioned first?
Because its purpose is just fundamental. It summarizes HCA's major accounting policies and procedures. It's HCA's customized rulebook.
The key to the code.
That's a good way to put it. If you want to understand how they calculated the numbers we just discussed, how they recognize revenue, how they depreciate their assets, you have to read the policies in this first footnote.
Okay, so that provides the framework. The second category gives us the specific details behind a single summary number, and the example here is the long-term debt footnote.
Correct. Imagine you see a single line on the balance sheet that just says long-term debt, $20 billion.
Right.
That one number is basically useless without the breakdown. The long-term debt footnote presents the specific granular details. It breaks down the types of debt, the maturity dates, the interest rates, the covenants. It turns a summary figure into actionable detail.
The third category is, I would argue, the most critical for risk assessment. The contingencies footnote, footnote 10 in this filing.
And this raises a really important question for you, the reader. What happens to important information that isn't a summary total or a line item yet? The contingencies footnote is where they present important information about uncertain events that have not yet been recognized in the financial statements.
So these are things like potential liabilities, pending lawsuits, or future costs that are still too uncertain or too early to assign a real dollar value to on the balance sheet.
Precisely. They are events that have not been recognized, meaning they haven't met the strict criteria for inclusion in the numerical statements, but they absolutely represent future risk, potential liabilities, or even sometimes potential gains.
So this is where the skeletons are buried.
Or where the treasure chests might be. If you want to know about major pending litigation or unquantified regulatory risk, this is where HCA is legally required to disclose it.
Finally, we have the fourth category, which is just required context for understanding their operations. The source materials highlight the segment and geographic information in footnote 14.
This type of footnote exists purely because the SEC or the FASB requires management to break the business down for us.
So it's not voluntary.
Not at all. Its purpose is to present information about HCA's activities segmented by their major business lines, maybe inpatient versus outpatient services, and its geographic spread across those 20 states in the UK. It stops you from only seeing the consolidated results and lets you judge which segments are really driving the growth.
So after all that, what does this all mean for you, the learner, trying to absorb this complex financial information quickly? We just used a massive real-world document, the HCA 10K, as our guide. And the main takeaway to me seems clear. The main financial statements are just the summary.
Absolutely. I mean, analyzing real-world companies requires you to move past the high-level statements. To truly understand HCA's performance, the structure of its profitability, that aggressive choice to maintain an equity deficit, and the internal accounting rules they use, you have to treat those footnotes as essential.
They really are the context.
They transform the 10K from a dry filing into really a comprehensive strategic risk report.
It's the difference between reading the headline and actually reading the entire article.
It is. And if we connect this to the bigger picture, just think back to footnote 10, the contingencies. It details uncertain events that are not recognized in the main financial statements. So knowing that significant risks like, say, pending litigation or major shifts in healthcare policy are often intentionally left unquantified on the balance sheet, what critical details might you prioritize looking for when you're reviewing a company's financial health? Which details buried in those footnotes could signal a major unexpected cost that just hasn't hit the bottom line yet? That's the knowledge that separates the well-informed from the well-prepared.